Well, frankly, it's really amazing because when you do things that are counterintuitive, most people look at you like you have three heads and they think you're absolutely insane. But when you show the results, then they talk about how brilliant you are. And everyone wants to be your buddy, which I experienced. But on my quest, on my journey there, I had a lot of people questioning my sanity. But one of the things and I'll answer it by saying this, and then I'll give you some details. I think the important thing is to recognize that the old traditional model, as I think I've made abundantly clear, doesn't work anymore. Traditionally, what would happen is they would take one financial instrument, investment strategy, call it what you will, and they put it again in that box. They cannot get themselves out of that one box. This strategy is used for this. This is used for that. Today, I think there's three criteria you really need to look at. Number one, you need to take each strategy, instrument, call it what you will, and you need to make the most efficient use of it. So in other words, it doesn't just accomplish one thing, but it accomplishes several things.
Okay.
All right, that's number one. Number two, this no one will argue with. I tend to be a little conservative. I say that kind of tongue-in-cheek because then I've also done some pretty foolish things, again, while I'm swinging for the fences, so to speak. Where if I had to do anything different, I would probably follow the advice I give. Because sometimes I'm guilty of not. I tend to be a bit of a cowboy. But one of the things I tell people is that you can have your cake and eat it too. There are strategies, there are specific investments out there that most people would not recognize as being as such that'll yield you high returns, but that are also safe. They also have a hedge against any kind of losses. All right? And ultimately, this one's huge, and I don't think I'll have any entrepreneur argue with me on this, but yet they don't do it. How can you avoid paying taxes? The tax man will pick your pocket like you would not believe, and based on what's happened in the last several years, it's going to get worse before it gets any better. So you want to be able to hit all of the above. In other words, find an investment strategy that ultimately is going to give you as many tax advantages as possible. Give you a real specific example, and this is one of the ways that I actually accumulated quite a bit. And it happened to be with real estate. And it wasn't so much the real estate, it's what I did with the instrument that I used, that traditionally is used to purchase the real estate, a mortgage. What are you told about a mortgage? It's a necessary evil. What do they tell you to do with that mortgage? Pay it off as quick as possible. I don't care if you're a multimillionaire, if you have a sizable real estate portfolio, or if you're just Johnny Lunchbucket. Single largest asset in most people's portfolio is their real estate. So one of the things an accountant, a CPA, will tell you, because he's thinking from a standpoint of cost, is to retire the debt as quick as possible. Well, by retiring the debt, you're also retiring your largest asset.
Well, share an example, if you don't mind.
No,
if we can play with some numbers here too, because that is something that a lot of people say, hey, if you make that extra payment, a year or two to your mortgage and pay it off in half the time, and that's been that's been something that the baby boomer generation in general is they hate debt. Pay off your debt. Pay off your debt. Pay off your debt. And something I've learned from you and that Kiyosaki is a huge preacher of is it depends on what kind of debt it is.
Right.
Because for me, it's about opportunity cost.
That's right.
I like debt. I like paying small monthly payments, and I don't want to pay it off because I could take the money that I would save for the down payment or whatever else and go make a 10-15% return somewhere. So who cares if I'm making, paying 8% interest on it if I'm making 15? So,
But I'm going to take that a little further.
Cool.
Because everything that you're saying, I agree with 100%, and I think the numbers will speak for themselves.
Sure.
But the opportunity cost, to really weigh out opportunity costs, and this is what most financial advisors don't do, is what if you didn't do what you're doing? All right? And let's say, let's say you're going to go out and buy a car and you pay cash. I'll pay cash. You don't want to pay, interest to a bank. Well, if you pay cash, that money, you just removed it from your portfolio. It's no longer earning money for you.
Right.
So what could that money have earned for you over a period, let's say, of 20, 30 years? And why am I using 20, 30 years? You're always going to need a new car. And this is where we start getting into the bank of you or infinite banking concepts that we talk about. But let me break it down in simplistic terms, without having a PowerPoint that actually brings things down.
You bet.
All right, let's say you have and I'm going to use this for easy math, 100K mortgage. So we're going to call this a mortgage. What's a good interest rate to use? Want to use 5%?
Sure.
Okay. So we'll say at 5%.
the math easy.
And to make the math real easy, let's say it's interest only. Thank
Okay.
goodness they're back, because to me that was one of my favorite financial instruments.
Okay.
Interest only, 5% of $100,000 is $5,000. So every year it costs you $5,000. All right? Let's not even talk about whether it's tax deductible or anything like that yet. The accountants are going, oh, you know, this is costing you $5,000. Well, I'm telling you, go out and take out that debt. And I know that you agree with it, but some of the folks out there might be kind of cringing, saying, oh, I want to be debt-free. We'll talk about that, because I think you should be debt-free. Well, what if I talked you into going out and getting a note for $100,000, and I said, I've got a great opportunity for you. Let's take this $100,000 and let's invest it at 4%. Now we're not making the arbitrage that you were talking about. I can earn 10 to 15. Would you do it?
I'm going to let you finish that.
Most people won't.
Not without a way to take advantage of it, sure.
Well,
Yeah.
let me explain the difference here, okay? Remember my penny story. This is, most people don't understand the difference. Simple interest. This is compounding interest, which means the first year, yeah, you do take a hit, because the first year you have $104,000. But the
Now,
next
this
year,
is an investment you're making 4% interest on a year.
correct.
Okay.
So that means you're losing because it's costing you $1,000 more in debt.
Right.
But this next year, year two, you're getting 4%, not of $100,000, but of $104,000. Remember the penny story? Let me tell you what, after a while, that'll rip this apart, completely rip it apart. See, so there's 2 points to be made here. You can make an arbitrage, even if the interest rate's lower,
Right.
in terms of the rate of return.
Yeah.
Now, do I think I can get 4%? I'll tell you what, I have investment vehicles that you can look at all day long that'll pay you 8 to 10%.
Sure.
Even in this economy, with interest rates being low, as low as they are. They're not difficult, to find. They're fixed. I mean, this is not the time to necessarily talk about those, but they are out there. What else? The other thing is, as far as the whole Kiyosaki theory, and I am so in tune and so in line with these guys, because I believe there's 2 ways of paying off a mortgage. And for everyone out there, here's the important thing. You should pay off your house. You want to be debt-free. But wait a minute, you just told me that I should take out $100,000 or $200,000 if I can. I say take as much as you can. Well, that doesn't make sense. You said to pay it off. There's 2 ways of paying it. You can pay it to the bank, and you mentioned paying extra principal payments.
That's a big thing
A lot of
people
people
are
do
told
it.
to go do. Yeah.
Okay. How much interest do you think the bank's paying them on those extra principal payments? 0.
Yeah.
Okay? So what you're basically doing is you might as well be taking that money and burying it in the backyard, because now the bank's going to take your money and they're going to go out and invest it elsewhere.
Right.
All right? And in fact, let's just break for a quick second. Let's talk about the banking concept. Imagine if I came up to you and I said, Mike, I've got a great idea. Give me all your money. I'll hold it for you.
Yeah, sure.
You're good. I like you, but I don't like you that
Sure.
much. Okay.
Yeah.
I'm going to hold it for you. Whenever you need it, it's available. I'll even pay you a little interest on it. I'll pay you 0.25%. Have a couple of accounts with me, and I might even pay you a little extra bonus.
Yeah.
And in fact, if you're willing to allow me to hold it a little longer, then I might pay you 1 or 2% interest.
Yeah.
All right. Most people say, I'm not going to give you my money and do that with you. I'll go to the bank. And I say, I just described the bank. That's exactly what the bank is doing. So I believe that you can create the bank of you, which simply means that you're going to pay off that $100,000 into a separate side fund. So if you're looking at a balance sheet with assets and liabilities, if you have enough cash to be able to stroke a pen and write a check to pay off the bank, your mortgage is paid. The
Sure.
difference now is your equity has gone to work. And this is a trick question. I kind of gave it away already. I'll ask people, again, simple math. If you bought a house for $100,000 and it's now worth $200,000, what was your rate of return on the equity? Everyone goes, 100%. No, it wasn't. It was 0. You got a 100% rate of return on your real estate. You can have that real estate completely leveraged out, or you can own nothing on it. It's going to go up and down in value regardless of what the debt service is on it. But the equity is doing nothing. So think about it for a second. If you own real estate, over the long haul, it's an appreciating asset. It also generates cash flow, which is, again, part of Kiyosaki's platform. It's part of almost any platform, really, if you think about it. But the important thing is that you're also now separating the equity and you're putting that to work for you.
Mm-hmm. Right.
You know, you're able to have your cake and eat it too. So that's just one example. And by the way, you asked me, how did I amass wealth?
Sure.
I was lucky. To be honest with you, I was very lucky. I started buying and selling. I'm from Boston, the Boston and New England area, southern New Hampshire. I started buying apartment buildings. And it was right at the beginning of the boom time.
Mm-hmm.
So I would hang on to a property for maybe, I don't know, 2, 3, 4 months. I'd turn around and flip it, you know, and the profits I was making on those were obscene.
Mm-hmm.
In some cases, because of the property was humming real nicely, I had decent tenants, low maintenance, I would keep it for cash flow purposes. When you have a market that's going up like that, guess what happens to rents? They start going up also. So I was able to cash flow them very nicely. So what did I do? So I went out and refinanced them, pulled cash out, and started acquiring more. And let me tell you, I mean, at one point I had like 52 doors.
Yeah,
you know,
exactly.
But that's not counting what I was flipping.
Right.
On a regular basis.
Right. Let's set the plate for people and kind of identify the pieces, with the end goal here being, you know, last time we met, I said I want to take care of retirement now, mm-hmm. and take that off my plate so I don't have to worry about it. Being an entrepreneur, you can be making millions of dollars one year and nothing the next year.
Sure.
You never know what's going to happen, right? So I don't want to count on having to do that when I'm 60 and something happen, whatever it may be, and then you're pretty much screwed at that point. So one of the things that I want to do now is take care of retirement immediately, and that way the swing from the fences line came in. I don't have to worry about it anymore, no matter what happens from my entrepreneurial career, business-wise. Lawsuits, you know, fire.
Your foundation is completely set.
Yeah, so setting the foundation, and so that no matter what I do, I can really go balls out. I can put money into my businesses, be as risky as I want to be from an investment perspective. But the retirement to set, that's there, and one of the safest ways possible. And so that's what we've started putting together. Why don't you, if you don't mind, share some details on what that would potentially look like, in your opinion. What do you think would be the best vehicles to get there, best choices to make? What are the pieces to the puzzle in creating that foundation?
All right, why don't we start out that from what you were talking about, Mike, as far as getting a retirement off your plate. I think before we start talking about retirement off the plate, let's make sure that we do some risk mitigation to make sure that you're not going to have anything that could potentially implode your retirement or any other strategy for that matter.
Cool.
So whether you're an intentional entrepreneur, someone who's got this wonderful vision in mind, who's very passionate about what they're doing, or someone who just found themselves in that landscape, there's some very key fundamental things that you really need to take into consideration. And these are the things that I most often see. Number one, and if you talk to any attorney or if you talk to any CPA, you're going to hear something to this effect, which is to create an entity as far as holding your business. So most people say, yeah, got it, like a corporation. Well, yes and no, but I think that if you want to keep it in real simple terms, the big question is what type of entity do you want to create? And one of the things I find to be the most effective is from an asset preservation standpoint is an LLC versus standard corporation. Mm-hmm. Now, why do I say that? Very simply is because although it does insulate you, and there's ways of piercing the corporate shield, so to speak, but nonetheless, it just creates one more firewall, for people to try and get through. If you ever get a judgment against you, and I think you and I discussed this a little bit with a corporation, and you have any kind of lien against you, you can actually be forced into liquidating the assets of the corporation, which could potentially put you out of business, especially in a down year, to satisfy some type of judgment. With an LLC, on the other hand, it's a whole other ballgame. The LLC, you cannot be forced to do anything. So you might get a judgment against you for a couple $100,000, and frankly, you're still in control. Because as a manager of an LLC, which is what you would be, mm-hmm. You can then decide, okay, well, we just made $500K, and let's say I owe Joe Smith over here $200,000. I'm not going to distribute any income to myself or any of the partners. So but there's still a tax liability from as far as the feds are concerned. So that $200,000 that you owe Joe Smith, you issue him a 1099. And when he gets his 1099, he will flip a wingnut. He'll go crazy, but it's legitimate, you know. And he's paying now taxes on $200,000 of technically phantom income that he never received.
Right.
He's going to go running to his accountant right away, and he's going to say, "Hey, can Mike do this to me? This isn't right." He says, "Yeah, he can." So the advantage is that now it gives you leverage. Now he has to come back to you and say, "Okay, look, we got to talk this out." And that's when you're off from 50 or 25 or whatever.
Yeah.
Income that you'll pay the taxes to go away. So that's one of the first steps. One of the other things that's very common that I see, and this is still important, and again, it's amazing that even with very high net worth people, is when it comes to estate planning, that all has to do with asset preservation also, and also if you're going to do any kind of legacy planning. They don't have a will in place. If they do, it's an outdated one. They also may or may not have a trust, or do they have the right type of trust put in place? Someone who might be just starting out might say, well, I don't think I need a trust. And in fact, I've even heard some attorneys who'll actually advise a client who has a net worth of several million saying, you don't need a trust. Your case is too simple. Of course, as you probe a little deeper, you find out that this attorney, this general counsel, he's not a specialist in the tax planning or the estate planning arena. Big mistake. Not to mention that one of the things that happens, one of the main reasons why you want to have a trust is to bypass probate. There's costs associated with probate. It can be anywhere from 4 to 8% depending on the state that you're dealing with. Trust will also give you the control, not only to minimize your tax impact, but it'll also give you control in terms of how those dollars are then passed on to future generations. All right, so let's go back to your original question, which is, all right, and there's a reason why I did this, when I kind of did a little bit of a end around here in answering your question about retirement.
Right.
I'm a big fan of a particular instrument, and I'm going to call it an instrument because when I tell you what it is, most people do one of these. They do a double take. I'm a big fan of life insurance, permanent life insurance. Now people say, well, wait a minute, what's life insurance have to do anything with my retirement? Forget that it's life insurance. In fact, let's just say hypothetically, you don't need any life insurance. Forget that. I'm looking at the components of what makes up a permanent life insurance policy. Now the key here is permanent, not the term. Because the term life insurance, the difference between term and permanent life insurance is that term you get one benefit only, and you have to croak in order to get it, which means only your heirs are going to get something out of it. Permanent life insurance allows you to start throwing money into the bucket. Universal life insurance is one example, one of the ones that I tend to like. Whole life is also very good when structured properly. Now what does this all mean? First of all, let me back up and say that term life insurance is something that, as I said, you have to croak in order to get. Whether you realize it or not, it's almost like going to Las Vegas. You're betting the life insurance company that you're going to die inside of, let's say, 20 years if you buy 20-year level term.
Well, correct me if I'm wrong, you can't borrow against term, right?
No, because
Okay, so
there's no cash value.
So the only people that benefit are your family, obviously, and those who leave behind, but that's...
You know who benefits more?
I'm going to guess Uncle Sam.
No, the life insurance company.
Okay, yeah.
because most people don't see it through. Something
Yeah.
happens and they end up not. That is the most profitable product for the life insurance company. So they figure out how can we make the most money and charge the least amount to get people to do it, because they realize the average that most people keep a policy like that's 4.5 years. So let me tell you what happened. E.F. Hutton back in the early 80s came out with a policy, with Universal Life. They were talking about this. And here's what happened. The government said, hey, you can put money in here and it's got all these tax benefits, which, by the way, let's just kind of cover that real quickly. The advantage of putting money into a life insurance policy is that it'll grow tax deferred, and when you pull it out, you don't pay any taxes on it either. Now, how's that? I remember sitting down with a life insurance agent. This is before I got into the field, particularly understanding how life insurance worked. And I remember the salesman would come over and pitch me on, hey, listen, you need to buy this policy versus a term policy. And the monthly premiums were a lot more. And I said, why would I want to do that when I can buy this cheaper? Well, you're building up cash value, and then you can borrow against it. Well, that's stupid. Why would I want to borrow against my own? That's my money. And, of course, I get indignant, and the guy did not have a good answer for me. He couldn't explain it. Here's bottom line. If you go to the bank and you secure a loan for, I don't know, you pick whatever figure you want, $20,000, $100,000. Do you claim that as income? No.
Yeah.
It's not
Right.
income.
Yeah.
So it does not go on your 1040. So your money that you're putting in, unlike a 401k that you have to tax on the way out, you pull it out as a quote-unquote loan. Okay? That's literally what you're doing, and it's totally legitimate. The feds acknowledge this. People took advantage of this. This is why I brought up the early 80s, because people were going out and buying, let's say, a $100,000 policy. They're dumping $1 million in there. Now, when it's really good like that for the consumer, the feds get, their antenna goes up, the red flags went up, and they said, whoa, we know that's what we said, but folks, that's not what we meant. So we had tax reform. All right? They came up with guidelines, and I'm not going to get into TEFRA, DEFRA, and TAMRA and all the different guidelines because it's more information than anyone needs, but basically here's the gist. The gist is they came out and said that if you're going to put in X amount of dollars, I don't care what the dollar amount is, you pick, you have to maintain a certain amount of life insurance above it. The problem is, and I'm using my little visual here, is that the way life insurance traditionally has been sold is that they structure it where you get this much life insurance because they're selling death benefit, and now it is a life insurance policy, and they're throwing a little bit of money down here, so there's a huge gap between this. And it's a very inefficient vehicle. You're overpaying for a death benefit, and it's foolish. This is why companies like A.L. Williams did really well, saying, hey, buy term, invest the difference. Totally made sense. So what we're doing is I'm saying, screw the life insurance, although we do need it in a lot of cases. This is where you make the efficient use of resources. I'm going to tweak it, where I'm going to try and lower the amount of insurance, and I'm going to put the maximum amount of cash that I can into it. You know what it performs like now? It's like a mutual fund. All right, so you're going to get stock market-like returns. You can get into more conservative ones. It gets you bank-style returns, that are fixed, fixed indexes, things of this nature, or your literally fixed dollar amounts. And it has a life insurance. What ends up happening is that when you net everything out, you get the same rate of return you would have gotten potentially with a 401k, or maybe a little under. All right, but you also get the life insurance on top of it. And when people say, well, if I do, let's say, an S&P 500, which stands for the Standard & Poor's 500, which are the top 500 blue chip stocks, and I do a mutual fund, or I have that as part of my 401k, there's banner years when they get 20%. There's other years like where you're talking about your parents, where a lot of people lost, 30 to 40% of their portfolios. The bottom line is, over the long haul, because this is what's always preached, invest for the long term, invest for the long term. You need to throw more money. Of course, they get paid that way, money under management. Well, the ultimate rate of return is probably going to be like maybe 8, 9%. Well, when you do it with an insurance policy, the average rate of return is like 7, 8%, but it's tax-free.
Right.
So it's higher.
Right.
So when I sit there and I tell people that life insurance is it's almost like a no-brainer, particularly for an entrepreneur. First of all, people, if you get a judgment against you, they can't touch it.
Right.
All right? So that's number one. If you ever force into bankruptcy, guess what? They can't touch it. At least in the state of Texas, they can't.
Right.
That's state-specific. The other advantage is if you ever need collateral and you don't own a home, for instance, that can serve as collateral. So it's got, so many different advantages. And the huge thing is when it comes to distributing money, as far as pulling money out, you don't pay any taxes on it either.
Right.
And again, going back to the penny story, this is where you can just, a lot of littles, just put it on automatic. Some people, again, have a hard time adjusting at first. I always tell you it's no different than federal withholdings or whatever the case might be. And in fact, that's probably one of the biggest challenges I think for most entrepreneurs is they're making quarterly tax payments. If they were ever in the W-2 environment, they start looking at gross dollars as net dollars when they were used to working in the net dollar environment.
Right.
So one of the things that I like to do with my clients is we'd like to systemize everything.
Yep.
I want to remove any thinking. However, I also do something that's kind of like a bizarre concept in my industry, which is we like to educate clients. I can talk a good game. I like to think I'm a relatively decent salesperson. People will ultimately say to me, hey, I trust you. I don't want you to trust me. I want you to believe me based on what I'll teach you. And I use sales tools, or not sales tools, but educational tools from other authors, folks that I know personally, who teach a lot of these concepts. So rather than reinventing the wheel, so I can say, oh, I published this book, although I am working on one, incidentally. The advantage is we have plenty of resources out there to validate what I'm talking about.
Would you do myself and everybody else a favor real quick?
Sure.
And list out the benefits of that particular tool because you said it's part of an efficiency plan as well. If you can get more than one use out of the vehicle, great. And I think there's probably 3 to 5 there.
Oh, there's probably more, but let's go for it, because I think we named some already, but let's just kind of do a recap. And I guarantee go ahead.
What's the ideal time to start this, other than being the sooner the better? But is there an age range where because you don't get the time under compounding that you would, obviously the younger you are, the more you do. Is there an age point, 40, 50, where you'd say, you know what, this isn't the way to go, or is it always a good time, in your opinion?
Age is not. However, time frame is.
Right.
Okay, so let me explain what I mean by that. If I am, let's say, 59 years old, I'm not that old, but if I'm 59 years old and I go out and get a policy, my cost of insurance versus someone like yourself who's younger is a lot higher.
Right.
Okay, so does that mean that I'm not going to be able to accomplish the same strategy? Absolutely not. It means I get less insurance. That's all.
Okay.
But I mean, I can accomplish the same type of rates of returns and everything else. It's all a matter of how I tweak it. What's interesting is the cost of insurance for someone like yourself is so cheap that all of a sudden you end up seeing, and in fact, I just did one for my son who's 28 years old, and I saw the amount of insurance that he can get for, relative to the cost, and I was like, dang, I think I'm going to take a policy out on him for me.
Sure, yeah.
So from that standpoint. So in answer to your question, no on age, but on time frame. If you're going to need that money, let's say in 5 years, that's not a good strategy.
Okay.
All right, and the reason why is because you're looking at about, realistically, a good 5 to 10 years, 5 to 7, depending on the way it's constructed, before you actually break even from everything you've thrown into it.
Okay.
Now, some people say, well, wait a minute, that's not good. Don't forget, you're also getting, that's where you are getting all the other benefits, too.
Yeah, let's list them out.
So what you're looking at is, number one, is that you can, this is a cash, I'm going to abbreviate, accumulation vehicle. Okay, so it grows tax deferred, which means you don't pay any taxes on it. You withdraw it without taxes. For compliance, I have to say it's tax deferred as opposed to tax free.
Sure.
Okay, there's certain agencies, government, regulatory bodies that will
little
say
ones
this.
no one's ever heard of.
Yeah. If we don't even want to go there, you'll get me started. I tend to go off all the time anyway. So that's that. This also can work as collateral. This also works to funding an estate, i.e. the DB, which is death benefit. Let me see, what else?
I was going to say I don't know if you would say an asset protection standpoint, but from a, like you said, if you get sued or whatever, it's not on the table.
Thank you.
I don't know what you'd call that.
The money is protected.
Okay.
It's complete protection from creditors. Classic example, this is politically incorrect, I don't care. I'm not politically correct. OJ.
Yeah.
Most of his money, in fact, the majority of his money was in life insurance contracts and annuity contracts, which you get the same type of protection. The only difference between, and by the way, that would be my next tier, would be an annuity. And then we can get into discussion about that. The only difference with an annuity is you do pay taxes as it's pulled out, but it grows tax deferred.
Okay.
All right. The advantage of an annuity versus, let's say, a 401k, it doesn't have all the strings attached, which I think we should compare them.
Okay.
Because since you brought up the retirement. So it's protected against creditors. It's also liquid. There's also no constraints on that liquidity.
So if I needed $100,000 tomorrow, and that's obviously in
And as long as you have the cash in there,
right,
you can get it. Well, it might take you 3 days to process it, but yeah, you have access to it. And by the way, do you mind if we go into a little bit, kind of touch lightly on the infinite banking concept?
yeah, definitely.